Hello, everyone. Welcome to the Beyond the Trillion Dollar Challenge, the fast evolving global sustainable debt market session. We are very glad to have you here with us today. We would like to start by thanking our sponsors, JP Morgan, Credit Suisse, Ping An, Moody's ESG Solutions, Luxembourg Green Exchange, Citi, Refinitiv, BNP Paribas, IHS Markit, Allianz Bernstein, FSD Africa, Inter-American Development Bank, ICMA, Mizuho, IFC, and Ashurst. Before we start, just a few important reminders. Please use the Q&A box to ask your questions. Thoughts, comments, and any other queries about the conference can be addressed via the chat box, where we have our team ready to assist you. Live interpretation is available in Portuguese, Spanish, Mandarin, and French. The headphone icon on your screen will lead you to the options. All sessions are being recorded and will be available to you on this app until November. Make use of the very exciting tools that SwapCard offers. Network with thousands of attendees and visit our virtual booths, where you'll find information about the latest reports and learn more about our incredible sponsors. Members of the media, for any interview requests, please visit the Climate Bonds virtual booth. Our comms team is ready to assist you. Many thanks for your presence and enjoy your session. And now Krista will present our amazing speakers. Over to you, Krista.
Thank you, Lisa. Good morning, good afternoon, or good evening, wherever you're dialing in from, and welcome to the first panel session of the day to kickstart the Markets Day of the Climate Bonds Conference. We're very pleased that you're all joining us. My name is Krista Tukiainen. I'm the head of research for market intelligence at the Climate Bonds Initiative. If you joined us yesterday, you already heard the dire warnings about IPCC's Code Red for Humanity and the immense action and funding gap that remains if we are indeed to meet all of the Paris Agreement targets on mitigating and adapting to climate change. But we're here to discuss the window of opportunity that we also have. There are many positive signals, some of which we've just heard from our CEO, Sean Kidney, and our friends over at Moody's. So, for example, the long-awaited net zero targets of the major economies of the world, including US and China, revising and setting them for the first time last year and this year. The European Union publishing its long-awaited sustainable finance taxonomy, and so on and so forth. Last year and year-to-date 2021, we've also seen record-breaking sustainable debt issuance, now reaching more than $2.5 trillion on a cumulative basis. So there is hope, but there are also undeniable barriers to mainstreaming this segment of the debt capital markets. And I am joined by a stellar and truly global panel to discuss why they are optimistic that we can do this and truly leverage finance to build a low carbon, or rather zero carbon and truly resilient world. So firstly, we have Mr. Sean Chang, the head of fixed income at Ping An of China Asset Management in Hong Kong. We have Julie Becker, the CEO of the Luxembourg Stock Exchange. Mr. Stephen Yeats, the head of UK investments and global head of fixed income beta solutions at State Street Global Advisors. We have Elvira Eurlings, who is with the Dutch State Treasury Agency in the Ministry of Finance. Philip Brown, who's a managing director at the capital markets team, focusing on sustainable finance at Citi. And last but certainly not least, dialing in all the way from the US very early in the morning, Lisa Botelli, who's a senior director in the multifamily capital markets team at Fannie Mae. Thank you, everybody, for making the time. We're very, very pleased to have you here. So we're going to talk about the reasons for hope, but I would like to start with a brief round of remarks from all of you to ask you what makes you optimistic about this space and what are the signals that you're seeing to sort of inspire you in the recent months and even years. Stephen, should we start from you?
Yeah, thank you. And good morning, good afternoon, everybody. I think as we're going to discuss today, there's lots of impetus and goodwill in order to achieve what we need to achieve. but we're going to recognise some challenges today. And for me, from an investor's perspective, I think the challenge with sustainable bonds has always been how do we make it a core allocation rather than a satellite one? When we first launched our first green bond strategy some years ago, the market was much more nascent than it is now, sort of 40, 50, $60 billion, which kind of really accentuated some of the challenges around diversification, liquidity. And we always have to remember that investors are looking to satisfy other requirements, risk return, liability hedging, reference to some sort of benchmark. So the growth in the market is incredibly important. And what I mean by growth is, being a more mature market. So we need a bigger market, which I think we're going to talk about today. We're definitely seeing signs that this is happening, but it's still not a huge part of the overall bond market. So we need to continue to try and stoke that growth. We also need breadth. We need coverage across sectors, sovereigns, securitized, corporates. We need to make sure that the market is rich and diverse, and again can provide many of the sectors that investors need to invest in order to achieve their asset allocation desires. And then, of course, we'll talk a lot about transparency and standardization. Again, huge progress here, but much more to do. We need more standardization for all of the reasons that I'm sure we'll talk about today. And we need access to data, and preferably data which is more standardized. These are all lofty ambitions, of course, and we know that it's not going to be a perfect journey. But if we want to get investors to have their core allocation into sustainable bonds, these are the sorts of things that we need to focus on.
Thank you, Stephen. It's a great way to set the scene, and you've picked up on many important points that I can't wait to dig into a little bit further. One of which is, you mentioned mainstreaming and meeting core allocations. A lot of that currently sits in sovereign debt, and not much of that sovereign debt is yet green or in other ways linked to the sustainable themes. So I'd like to hand next over to Elvira, who has obviously been part of structuring a green bond for a sovereign government. What do you make of this? Where do we go next?
Thank you, Krista. And when you asked the question, what are you excited about? If you ask me personally, I'm very excited about seeing more governments becoming active in the green bond space. And I agree with Stephen that needs to be stepped up. But we issued our green bond 2 years ago, and we have now 11 billion outstanding. We thought it was a very exciting project. We hope we can do more. We're waiting for a new government to be formed, but we hope that we get a go-ahead soon, that we can continue issuing green bonds. But at that time, there were only a few countries joining the green bond space. And what I heard on many occasions when I went on the Green Bond Roadshow from fund managers, for example, the impact fund managers, that when the sovereigns became active in the green bond space, they started raising funds for impact funds, and it allowed them to diversify their portfolios in a much better way and get more climate related financing becoming available. So I would really hope and encourage other governments that have not yet considered issuing green to do so. I think the narrative after the pandemic of building back better and greener would hopefully allow these governments to do so. But if you now look at how active governments have been, more than 30 governments have already issued some form of SRI bonds, social, sustainability linked or green, much more focused on green, I must say. But only already this year, governments from around the globe have sold $39 billion in green bonds so far. So that's even surpassing all of the amounts that was issued by governments of last year. So I think that's exciting. It's encouraging. And I truly believe sovereigns are catalysts for the green bond capital market.
I agree with you more there, Elvira. Thank you very much for that introduction. Maybe if we continue on the issuer side, Lisa, you represent what is still the world's largest green bond issuer. What are you seeing on your side of the pond?
Sure. So I think you had mentioned hope. I think over the past 18 months, we've seen a dramatic ramp up in interest in the GSS market, both from issuers and investors in North America. It's increasing awareness about the growth of the market, but also largely increasing climate-related risks in portfolios. So we're seeing a definite focus in that market. In addition, the U.S. re-entry into the Paris Climate Accord this year has also helped to focus attention. We are looking much more, as we always have, to Europe to see what this might mean for U.S. regulation. and legislation, and how that might impact our investor base, as well as requirements for us as an issuer. So I think it is definitely on the upswing. It is definitely hope related. I think on our part is very focused on education right now. I think a lot of the stakeholders that are in the role are coming up the learning curve and trying to understand what can be done and what has been done.
Thank you, Lisa. I think, if I'm correct, this market education point might ring true on the other side of the world as well, in China and the greater China area. Sean, what would you like to tell us by way of an introduction to your views to this topic?
Right. We think that China, obviously, as one of the initiative in the region, would definitely contribute a lot. If we referring to, for example, the green bonds issuance by 2000, the statistics up to 2019, there were a total of more than $68 billion worth of green-related bonds being issued from the China issuers. And this market is keep on growing as China also one of the largest contributing to this carbon reduction program under the Accord de Paris. We think in this part of the region, investors would have lots of initiatives to follow, and the Chinese governments, they evolved to committed to this carbon neutral target by 2060. And as the leader in this field, Ping An also have a lot of research and contribute to this, part of which we have the responsible investors under the UN regime to monitor and also surveillance on these green bonds and sustainable bonds to make sure that, for example, within this region, China is really making progress to this target. So we are excited about all this development, and like Eva mentioned, that government policies and initiatives is one of the main drivers to the motivation and investors' appetite in this field. Thank you.
Thank you very much. I'd like to hand over to Julie next to get your reflections as well, because we've talked a little bit about definitions and government policy. Obviously, as the Luxembourg Stock Exchange and the Luxembourg Green Exchange, you're a key intermediary in the space, but you're also recently a data provider to try and help build transparency into this market. What do you make of reasons for optimism as we stand now?
Thank you, Krista. Well, maybe for the positive element first to underline interesting figures, as you mentioned, very important new sustainable bond issuances to come in 2021, which would exceed indeed $1 trillion. But it's very interesting to underline as well that at the end, it took 13 years from the first green bond issuance issued by EIB in 2007 to reach the first trillion of cumulative sustainable bond issuance. But now, this year, we may reach the second trillion in only 1 year versus 13 before, which is, I think, indeed very interesting to underline an optimistic element as well. Within the main barriers that we should overcome, and definition you were mentioning, I think what we really need is international coherence to address these global goals. So what we should really focus on is really try to minimize contradictions, avoid market fragmentation, and really create synergies between different international policies and enable really developing countries to benefit and to increase the effectiveness of development cooperation. And of course, all of this should be done very quickly. We need to move fast, especially because transition involves action. The role of exchanges in all of this is clearly to bring clarity to the market and promote issuers' efforts to more transparency, but also help investors to better understand all this data, because we are lacking convergence of definition, harmonization of standards, common processes. So what we are trying to do indeed as an exchange to make sure that Understand can make informed investment decision is to structure data in a way that investors are able to benefit from accurate, comparable, up-to-date, and meaningful data that are available indeed on a centralized database that we built and we launched September 2020, and that we are further expanding to new financial products such as sustainability-linked bonds that we may talk about afterwards.
Excellent. Thank you so much, Julie. Philip, you have been championing this agenda for a while now, and you obviously work directly with a number of different types of market participants on a regular basis, including, importantly, issuers to try and build scale into this market. Are you seeing this kind of speed right now that Julie just called for? What do you think?
Yeah, thank you, Krista, and thank you, everybody. Very happy to be here speaking this morning. I think I have to agree with everything that has been said so far. I think one of the biggest grounds for optimism going forward is simply the mainstreaming of climate finance now across all constituencies of the market, driven by asset owners. I'm sure State Street, Stephen's team is seeing more demand from asset owners for environmental product than they're able to fulfill. It's one of the problems that Stephen challenges that Stephen spoke of. And where the asset managers are looking for product, then issuers are also following. But I think that, climate has been mainstreamed now onto the corporate boardroom agenda. And it's clearly the financing of companies is part of that agenda. But I think we should all be encouraged that it is now part of every conversation that we have with all of our clients. I mean, I think we've heard a lot of statistics and data, but if I can just throw one other statistic, I think that impresses me and illustrates, I think, very well the growth. If we look at euro-denominated investment-grade credit issuance in 2021, 20% of that issuance carries an ESG label this year, compared to just 6.5% last year. And if by investment-grade credit, I mean largely financial institutions and corporates. And if I look at corporates alone, euro-denominated investment-grade corporate issuance is 27% of it now carries an ESG label. And I think that more than anything else just illustrates the recognition of the importance of sustainability to the corporate agenda going forward. Everybody recognizes the significance and importance of sustainability to corporate strategy. I think this is why we have cause for optimism. I think it's been a fabulous year in terms of growth of issuance so far. Typically, the last 4 months of the year are the busiest. And if I look at our pipeline of deals to come from across the globe, it does indeed look like we're going to have a very busy close to the year. So hopefully everybody's optimistic forecast for total issuance in 2021, I think they're going to be realized.
Thank you, Philip. I hope you're right. And I would obviously like to plug the Climate Bonds Market Intelligence and Data here as well. If you're interested in reading more about our predictions of how the market's going to grow under these different label buckets, go onto our website. It does look like we can reach $1 trillion of green bond issuance either in 2022 or at the latest in 2023. So I would share the optimism. Now, you mentioned corporates, Philip, and obviously one of the key criticisms that has been levied at the green bond market and the general use of proceeds bond market that carries any kind of sustainability related label is that anybody can issue these bonds. If you have financing needs and you have the appropriate assets, project activities, even expenditures to finance, then it's okay. It doesn't matter what kind of issuer you are. Steve, I know that you've been looking at this as well from the SSGA perspective. How do you go about identifying credible opportunities in this space to look at an entire issuer's transition, especially as it relates to corporates, if we start from there? Any reflections?
Yeah, sure. I mean, I think corporates is in some ways the easiest place to start. I think for the reasons that Philip mentioned, there's a rich universe now of issuance there. And indeed, even beyond the kind of labeled bonds, there are companies who issue bonds, incidentally, who are doing a lot on the transition. So to me, like the starting point is you have to cast your net as wide as possible, because as I said, if you want to say to an investor, well, you are going to replace your European corporate exposure with something that is climate aligned or sustainability focused. There are these other kind of tensions that you need to recognize, as I mentioned: liquidity, diversity, risk return. Obviously, these are key things. And if you really want to move assets and move assets to the core, which hasn't yet happened, I would argue, even in corporates, but is being talked about, then you need to cast the net widely. Now, in terms of green bonds and sustainably linked bonds, we leverage a lot of the work done by the Climate Bond Initiative. As you know, I think there's a huge value in having independent organizations look at these issues and classify bonds. As an industry, if we really care about change, then having organizations that cut across the industry is incredibly important, because it's not only helpful for investors, but also, I would imagine, for issuers to have more clarity about what investors want. So I think that's the first thing. The second thing is, how do we think about the transition and how do we think about the transition, but also reducing carbon intensity of a portfolio? So I think you need both. You need to uplift those green bonds in the portfolio, also look at issuers that don't issue green bonds but are helping with the transition, and then at the same time try and kind of remove capital or underweight issuers who are either not looking to kind of consider the transition or are highly carbon intensive. So I think that you need both in order to get that breadth that I'm talking about.
Thank you, Stephen. So if corporates are the easy bucket in this, then why don't we talk about sovereigns a little bit? Elvira, what does transitioning for an entire country look like? Are you intending to leverage green bond issuance going forward? Is there anything else in the mix?
Yeah, so as I said, so we have now 11 billion outstanding for ourselves, issuing a green bond from a sovereign always needs political backing and support. And as we are forming a new government, we need to wait a bit for their go ahead. Building also a bit on what Stephen has said in terms of, and also your statement, Krista, like can anybody issue green? And I think for a sovereign, the bar is also quite high to make sure that what you claim, that's also what you do. And there's a reputational risk at stake there. And when we issued our bond 2 years ago, there were not so much taxonomies floating around. So we had an SPO, of course, validating our green bond framework. We had the CBI coming in, also certifying our green bond, because we wanted to make it as we say, a dark green framework, that it was undisputable, a framework with expenditures included that significantly contributed to the Paris goals. And we wanted to have no discussion about it. And I think that's still the bar that we try to reach also for our future green bond issuances. I think now we have more taxonomies around in our part of the world. We have the EU coming out with a taxonomy. I think that is helpful. It makes sure that we have a sort of common green language on what we view is green and sustainable. What we have, and at the same time, so I think it's helpful. At the same time, also the investor community should bear with us a bit because it's extensive. And I think for issuers, I think our obligation is to be transparent on which fronts we can comply with these standards, on which ones it's still work in progress. Also because the taxonomy, for example, on the adaptation part of expenditures has not yet been so fleshed out. So in our case, we have included a significant part of climate adaptation expenditures. Few years back, also we had to work with CBI to see how it fits their standards. The same now with the taxonomy. So I think it's work in progress. It's helpful, but it's also something that still needs time. But I think it's helpful also helping more sovereigns presenting solid green bond frameworks.
Absolutely. You've highlighted a few really important things there around the definitions, and I wanted to turn to Sean for a moment. China's obviously had historically some convergence in its green definitions vis-a-vis the rest of the world. Now we're seeing some developments that are quite landmark in bringing those definitions closer together to the more established systems in Europe, for example. At the same time, though, and we'll get to SLBs in a minute because I know there will be audience questions about those, so I'd love to get your most controversial views, but we've also seen the so-called carbon neutrality bonds from China. Against this backdrop, what do you make of where those definitions and the kind of direction of travel for Chinese sustainable finance is headed?
Right. Thank you for the questions, Krista. I think you highlight the importance about the government initiatives as well as in terms of China contributing to this sustainability and the carbon neutrality bonds is one of the great examples that we think the initiatives is participating not just the public but also the private, bringing in, I think earlier Stephen has mentioned concerns about liquidity, concerns about investors' participation, and being one of the participants to carbon reductions. China has contributed to the global target by those date and years. I think these will contribute to the utmost those targets being achieved, at least for the nations and regional. I think initiatives from the government, such as I think Xi Jinping in 2015, he laid out some kind of a groundwork and asking the corporate body to take those initiatives throughout other regulators, CIRC, CBRC, and a list of policies like, for example, the 3-line 1 list has all these red lines, what to do and what cannot do, by these green initiators, and that becomes the framework. And like you said, I think China central government is very eager to build this mapping with the taxonomy in Europe, and this is also a great milestone if it is proven as a successful one, because I think what recognized in Europe can also mimic or mapping here in China and being recognized, most important of all. And as one of the major participants in carbon reductions, even China's represent about 30% of these carbon footprint. So to be a meaningful diversification, not about risk, but about carbon reduction, without investing in China, I think global investors would missing a big puzzle. So we think that the central government initiatives here in China can able to fill that gap. Thank you.
Thank you. You're absolutely right. And I think there's another country in the mix that is under a sort of similar situation, at the risk of contrasting the two. The US obviously recently revised its nationally determined contribution. We've also seen record issuance from across North America, from all types of If I may kindly ask the rest of the panel to mute themselves so that we don't get the echo. Thank you very much. Great. So to Lisa, the signals are there. I wanted to specifically ask you, we've talked about mitigation and carbon emission reductions, which is obviously a key piece of the puzzle in the US as well. And that's what most of the NDC targets are sort of culminate on. There's also a resilience angle to this. And given that you operate in an industry that looks at physical real assets, specifically buildings, multi and single family homes, are you seeing any movement towards incorporating a broader view to climate investing that encompasses adaptation and resilience building as well as reducing emissions?
No, definitely. I think as a country, we're trying to figure it out. And I think a slightly different take from the discussion about China is we are still really risk focused, and it's very front of mind, obviously, this year as well. So I do see a move towards resilience. I think the challenge for us is, resilience from an entity like us, which is, dealing with the housing specifically without infrastructure, probably isn't the right way. So I think it's a hand in hand kind of effort. We see a lot of muni issuance lately, around green to begin with, and then I think also kind of getting into that conversation about what can we do for resilience. So I think you'll see a lot more in the future. I do think that because the SEC was out with the RFI earlier this year, as well as our own regulator, both around climate risk disclosure and climate risk management, I think you will see more coming from the regulator side that should provide guidance as well as entities like ours who are kind of looking at the topic to figure out what impact we can have to try to move that moment forward.
Thank you, Lisa. There's a question from the audience that relates to this, and I'd like to turn to Elvira at first and then Philip. Have you, Elvira, seen a surge in interest in the aftermath of extreme weather events, for example, the floods this summer in Luxembourg, the Netherlands, and elsewhere? And how do you think the government could move quickly to capitalize on that?
Yeah, thank you, Chris. I think, unfortunately, a few weeks ago, the vulnerability of especially our country to flooding has already been proven. So half of our country is actually vulnerable for flood risk. So when we designed our green bond framework and we studied the eligible expenditures, it was for us very clear that it had also to include a significant climate adaptation part. So all the investments that we do to strengthen our dikes, to manage water levels, distribution, they have been included in the green bond framework, because we also wanted to really put a spotlight on the importance of these expenditures. And almost 3 billion euros in our green bond framework has to do with climate adaptation measures. And I'm sure that also future green bonds coming from our end will include these type of investments, because we are, of course, building lots of wind, solar, and it's important to also have these climate mitigation expenditures in it. But I think the climate adaptation part really relates to our local context, and I think there are many countries that can relate to that. And to put it also in agreement, ask the attention from investors. When we went on roadshows, the investors really understood that we had to include this part. It was also appealing and interesting for them to look at these issues as well. And again, the importance of having these expenditures in the framework was evident to us. And I think many more countries are now looking there. On the criteria and on the impact indicators, I think it's a bit more complex, to be honest. You cannot report on the greenhouse gas avoided impact indicators when you strengthen dikes. So it does include also, from the issuer's point of view, a bit more creativity. Think about what kind of indicators is it that the investor community like to see, that we can also commit ourselves to. But I think it has been worthwhile, the effort.
Excellent, thank you. Lots of interesting and important points highlighted there as well, and we'll get to the particular can of worms that is impact in a moment. But before that, to Philip, I know that you also work with social bond issuers. The social resilience angle of this is obviously crucial if we are to get to a truly just and sustainable society. There's somebody in the audience that thinks that there is no benefit compared to conventional bonds for issuers to issue any kind of labeled debt, and it doesn't justify the effort. From a specifically social bond perspective, do you reckon that's true, or have you seen any interesting successful case studies of late?
I think the question about cost saving is one which I feel has passed us now in most of the conversation we have with potential issuers. And I feel that to some extent that's missing the point. You know, I think that self-evidently the demand for ESG labeled product now exceeds the supply. So we talk about this greenium, the green premium that is achieved by sustainable issuance. And I think that applies to social to some extent as well as to green. But I think the motivation of an issuer to approach the market should not necessarily be just simply to cut costs, but it should be to highlight that they have a sustainable strategy, that they are a sustainable investment, and that they are addressing these issues, which are very, very important to all of their stakeholders. I think, all of the, well, just to go back to Elvira's comments there, I hadn't really thought about it until you highlighted your question, Krista, but I think the success of the Dutch in climate resilience sort of kept Holland out of the headlines and out of the TV screens during the recent flooding we had in Europe. And if we talk to many sovereign issuers around the emerging world, they're getting advice from the Dutch government about how to prepare for resilience and how to do that effectively. And I think social bond issuance is also something that clearly resonates. I mean, the biggest social bond issuer in the world has become the European Union with their response to the pandemic. And, I think all issuers' response to the pandemic was something that it had a great resonance with investors, and it helped to crowd investor interest into that issuance. But I would also just like to go back to the side effect. We are seeing climate change now happening across the world, and I think this is very helpful in accelerating the agenda and policy change which has to happen. And I think as we move towards, I think ambition is something that we've not talked about a lot yet on the panel, but I think we certainly feel that led again by the investor community, ambition is becoming more and more important. And I think with any kind of issuance, whether it is social or more particularly climate, I think investors want issuers to be able to demonstrate ambition. And I think we now talk about 1.5, we are migrating towards a 1.5 degree scenario rather than the sub 2 degree scenario. And I think, we should be also encouraged by the increasing sophistication that there is in the market and the increasing demand that there is from the investor community for non-financial reporting, such as we are seeing regulation come in within Europe, which I think is also, broadly speaking, helpful. Stephen opened the whole debate talking about data. So, I mean, it's a long-winded answer to the question, but I think the question simply about saving a basis point here or there is really a little bit missing the point. I think by demonstrating to all stakeholders that you have a sustainable strategy is going to help to reduce your cost of financing in the longer term, and it's going to demonstrate that you are a sustainable investment with that you have a policy to addressing these points. I think everybody wants to be perceived as being, recognizing there are going to be ESG winners and losers in every sector of the economy. And I think corporate strategies, as I said earlier, are very much focused now on what it takes to be a winner in the world going forward.
Thank you, Philip. Beautifully put. For those of you who do care about cost to the issuer, do tune into our Greenium session later today, because we would beg to differ on that point a little bit. Lisa, did you want to come in on this as well?
I would definitely have some sympathy for the person who wrote the question. It isn't free, right? It's not cheap to do these programs. But I would say to Philip's point, at some point, it's not going to be tenable not to have a program like this as a company. There are look-through ratings that even for our regular debt issuance that are looking through to us as a corporate and our ESG strategy. And I think at some point, if you aren't actively involved in this market going forward, that there will at some point be a penalty assigned to your debt. Maybe we're not seeing it every day yet, but I think it's coming.
I really hope so. I'm going to pick up on a few points that Philip also said and hand over to Julie. We've had conversations about the green definitions in Europe, and I know that you're a great advocate of the taxonomy. There was an audience question specifically to say whether we should be worried about the possibility that some European sovereign, sub-sovereign, and agency issuers would not adopt the EU taxonomy or specifically the EU Green Bond Standard, potentially even the European Commission itself. What would you say to that?
Well, I would say that the taxonomy is overall a process. And so that process, which allows to determine what is an economic activity contributing to an environmental objective, is instrumental. It's absolutely instrumental to avoid market fragmentation and make sure that investors understand that the activity to which they are contributing is contributing to one of the environmental objectives. And the most important is that it is assessed in the same way. So the process of the taxonomy should be not only adopted within the EU, but in my opinion, worldwide. And that's why I also really encourage the work initiated by the International Platform on Sustainable Finance and the task force led by China and the EU to assess commonalities between taxonomies that already exist from the countries member of this initiative, and that should lead to a common ground taxonomy, which is expected to be released quite soon. And if I can say it as well, what I really expect is that this will become universal. And I was recently asked if what I thought about potential taxonomy in the US, if I heard anything about that, and I said not to my knowledge. But what I would really expect, because I know that the US are working more on the climate-related disclosures, which are extremely important, of course, but out of which we should also try to reach convergence. But for the taxonomy, I think having a universal backbone of classification or process of assessing the economic activity to which you are contributing is really key for investors, especially because the challenge we are facing is global. So the way it should be assessed and the way investors could understand, they can understand and they will understand the different shades of green, but they need to have really a common backbone to be able to be sure that how it is assessed is the same, it's similar from one country to another.
Thank you. I want to give Sean the opportunity to remark on that. He's nodding along. The common ground taxonomy. Please.
Sorry. No, just wanted, on the contrary, to say as well that while some countries may not be ready to endorse the EU taxonomy and the different tools that are being put in place, like EU GBS, others already, other issues already aligned and foresee to align is a green bond framework, which has been externally verified as well, and they do align with the EU taxonomy. So this is also something which is feasible. The first one to have done so is Aon in Europe.
So work in progress. Perhaps actually before we move on to Sean and the China perspective on the common ground taxonomy, Elvira, I know that you've also thought long and hard about the usability of the EU taxonomy, and I'm sure the EU GBS as well. Any remarks on what Julie has just said?
Yeah, I would agree that it will converge, I guess, to a universal set of criteria, and I think that's extremely helpful around the globe. And we noticed already 2 years ago that having kinds of certifications or compliance with universal applied standards, that it helps the investor community, it helps the credibility of frameworks. As I said in the introduction, I also feel that it's still work in progress in terms of the applicability of these standards to sovereigns, for example. So in our latest impact report, we tried to already explain a bit after the fact how our framework that we issued 2 years ago, how that would align with the current EU taxonomy. And I think we have come a long way, but there's no 100% match. Because again, it's complex. There are all kinds of sub-criteria, do not harm criteria below the common language. It's quite an effort to gather all the data to really show also to your auditors that this is something that you can comply to. So it's work in progress. Also bear with the issuers. We need a bit of patience also from the investors to comply by the end of the day. But again, I think it's a very positive development that we work towards a global common language in terms of what is green and what is not.
Thank you. Sean, do you think it's viable for us to think that the common ground taxonomy could quite quickly be adopted as the de facto system in China? What are your views?
Well, yes. I think personally, I think it's important that we could able to sort this out as soon as possible. So every nations have their common ground and to map, those taxonomy and would be great to global investors because we have been long waiting for this to happen. And as in China, the super body, the governance like the CBRC, they have guidelines for banks, what to able to lend out and what that categorized as taxonomies or related to it. And we think that, way back in 2011, the Chinese central governments already have these kind of concepts under the 12 5-year plan. And we do believe that with more initiatives and policies coming up, especially credit-wise, banks as one of the major gatekeepers in mainland, and they could be the surveillance, and under that kind of policies framework, we think that it will get closer for China to implement these kind of a taxonomy across nation. As the investors, in this part of the region, and we are exciting, to this to happen because, for our global portfolio, we invest into China, we invest globally, and we share common language, and that's most important of all. Thank you.
Thank you, Sean. Maybe a follow-up question on that, actually something that came through from the audience, and I'd love to hear any reflections from other panelists as well. The question was a follow-up to the GBS, the Green Bond Standard question, to say that it was designed, rightfully so, as a global standard for all kinds of issuers from all regions beyond the EU. So what do we think needs to happen next for this Green Bond Standard to inspire other regions and become a truly global standard? Is that the way to go, or is there sort of better way that you think is more feasible? Any reflections? Maybe we can start with you, Sean, and then move to Lisa, given that we're at the sort of start of the journey in standard setting.
Right. I think it's good to have, for example, if I recall, paying on first green bond, China bond investments, we partnership with Climate Bond Initiative. And it was a great milestone for us because we share those taxonomy with CBI. And that implement those China bonds to map with those global standards. And by referring to this example, we think that it is one of the first steps, and we made that first steps, and that probably the progress are coming through. And with the central government's initiatives, I do believe that it is important that globally we share these common policies, and that will be a good framework to all of us. Thank you.
Thank you very much. Lisa, any reflections on that?
Sure. So I think, I hate to be the one that says this, but I think global standards, great. I think that's definitely the direction we're moving in. But even where we are today with the EU taxonomy, we've seen countries personalize them for their particular country concerns, generally climate-related country concerns. And we've had the same thing happen on the buildings when we worked with the TEG on our side. When the taxonomy was being written, we talked about the building requirements. And while we agree on maybe the energy consumption building requirements, we in the US had a little bit more water focus on our program than we saw in the EU program in terms of building. So I think that, yes, I think we'll move towards some generally influenced global standard with slight nuances. And I think the way we get comfortable with this is massive, clear disclosure, which we say all the time, right? I think transparency solves this problem. If there is a standard that's slightly nuanced, then we are just very public about what the nuance and the difference is so that the investors can make their decisions.
That transparency point is beyond important. Thank you for highlighting that. There's a question from the audience that I'd like to direct to Philip, actually. Shifting gears a little bit back to corporate issuance, we'll start with that, and then we'll talk about SLBs finally. Somebody was asking whether you, as an underwriting institution, would consider giving discounts to issuers from your fees to signal your commitment to be an ESG institution or a sustainable bank. How would that work? And maybe you want to talk a little bit about your strategy of becoming a more sustainable, dare I say, net zero bank quite quickly.
Thank you. Another provocative question from the audience. I think, if we're going to see this product mainstreamed, it's not about people losing money. I think we have to find a way to, and we are finding a way for, this has to be a profitable, there's opportunity in climate change. It's not about, it's not about reduced profitability for the world. It's about an opportunity and growth. I think that's what we should be focusing on, rather than reduced opportunity. Within the sustainability linked bond market, one of the most frequent questions we get is, why do we talk about a step up coupon structure, which is not really aligning the interests of investors? It's aligning the interests of investors in a sense with failure. So why don't we have a step down structure? And I think clearly this is something which I guess Stephen would not agree with. And I think we have to recognize, the issuers need to recognize that the achievement of sustainability goals, of ambitious, sustainable goals, that is the alpha. Stephen is the head of Beta at State Street, but achieving sustainability goals, achieving climate goals, that is the alpha that fixed income investors are looking for. And if you give that alpha opportunity away in a step down coupon structure, then the motivation for investors to engage is much reduced. In the loan market, we do have the idea of a structure whereby, the undrawn commitment fees for revolving credit facilities come down if KPI links are there. And I think in the derivative markets, we're looking at structures now whereby the financing cost actually comes down with achieving goals. But I think it's very difficult to introduce this kind of short-term reduction in financing through green issuance. I think we should be looking again at the longer-term goal, that by demonstrating that you have a sustainable issuance policy, your long-term cost of funding is going to come down as you're perceived to be a viable counterparty. I think the sustainability-linked bond market generally is a very interesting innovation in the market, and clearly we're seeing very significant growth there this year. Last year, when the product was really just introduced, we saw less than $10 billion of issuance. This year, we've seen so far 50 billion, and perhaps we'll approach 100 billion by the end of the year. But I think the market has done more than is represented in just the sheer issuance numbers, because I think it's introduced the concept of management strategies towards these key performance indicators, whether they're embedded in financing yet or not. But I think this is, SLBs, even though use of proceeds structures are 90% plus of the market and may remain so in the near term, I think SLBs they dominate the conversations that we have with issuers, and every issuer is thinking about KPIs now in a way, as a way for them to demonstrate the ambition that they need to have to be able to demonstrate a sustainable strategy. I don't know if that answers the question.
Oh, it does, and I'm sure we'll get more. The audience is on fire today, which is great. Stephen, do you agree? Please.
I think what we need to do, and I think we definitely aren't here yet, and I think the question picks at this topic, is reduce, I guess, the friction involved in allowing it. Ultimately, the underlying owners of as I was just saying before, the aim has to be to try and reduce the friction. And what I mean by that is there's lots of impediments to maybe I'll try again.
Thank you, Stephen. Sorry about that, everybody. We're trying to figure out the echo to make sure that you can actually hear the speakers. Yeah. So please go ahead.
Speaking of friction, so I think that, as I was trying to say, I think if we want investors, and ultimately the underlying owners of the capital is what really counts, to be able to make choices and to be able to make the right choices around sustainable investing, we do need to reduce the frictions. And I think the question did pick at this, but there's much more to that than just kind of costs of issuance. This is a complex subject, so there is going to be complexity to it. It's not as simple as labeling things kind of in a very simplistic way. To get to a simplistic label like green or not green, you have to do a huge amount of underlying work, both on the issuer side and on the investor side and on all of the data provision side that exists. So you're trying to take something that's complex and reduce the frictions. And obviously capitalism is a good way to do this. So I think what Philip was getting at is that capitalism, there is an opportunity here, but we need to make sure that is balanced with the need to promote a less friction orientated experience. So I think that this comes back again to transparency and data and all of these things. This is absolutely crucial, because at the moment, in reality, right, if you want to invest sustainably, and I do think many investors and asset owners and ultimately underlying owners of capital do want to invest sustainably, you have to kind of navigate more complexity, which I think is fine, but requires education. But you also have to, there are, putting all that data together in a robust framework. There's lots of cost to that, and I think we need to get to the point where sustainable investing feels much less friction than it does already. And I think that's really, I think what the question was picking at. But that's where I think the kind of financial services industry and the kind of technology industry and all of the other market participants out there have a big role to play. And I think that you're starting to see that in a very meaningful way, but there is a lot more work to do, I'd say. I do think that, as I mentioned before, I don't think in fixed income that sustainable investing is yet mainstream as it relates to climate. I think ESG strategies are certainly in Europe, for example, becoming mainstream. And I think conversations around how do I get a more sustainable portfolio are becoming mainstream. But actually how you do it, how you balance the cost, the risk, the liquidity, those are really the issues, the thorny issues that in order to get to something much more mainstream, we need to tackle. The good news, I think, is that I think there's genuine desire, as you would expect, as we all live on the earth, to solve this. But we do need to continue to push pretty hard as an industry and as a kind of, and I mean industry in the broader sense, in order to solve some of these frictions.
Absolutely. And it's interesting, you both mentioned this sustainability linked bond. And for those of you who might not be familiar with this jargony term, these are instruments that are linked to targets at the entity level, typically for corporates to achieve certain targets as part of their overall sustainability strategy. They're obviously more flexible in some sense than our use of proceeds labeled bonds, because you don't have to ring fence your pool of eligible assets and projects at the outset. We would maintain, though, that there's some risk in sort of making sure that you can ensure the ambition level and the appropriateness of the targets as well. Anyone have any reflections on that, whether this is indeed a sort of material risk to the space, or do the potential benefits outweigh that? Philip, could I start with you, given that you've worked with these issuers?
So I think ambition is something that second-party opinion providers are increasingly demanding of, that issuers should demonstrate within their key performance indicator targets. I think investors are also increasingly demanding of ambition, and I think it is complex to come back to Stephen's initial point about standardization. I think one of the risks to the further growth of this market, or one of the impediments to the further growth of this market, is just the number of key performance indicators that we see. Sometimes even across the same industry, we see different companies having different indicators. And I think the standardization of indicators would be helpful. We are beginning to see that in terms of the dominance of decarbonization targets. But I think it is very interesting, and one of the classifications of labeled ESG issuance is transition bonds. And I think sustainability-linked bonds have pretty much taken over from transition bonds. And I think the work of Climate Bond Initiative and others to define what is an appropriate transition, what is an ambitious transition pathway across different industries, is very helpful for issuers to be able to define appropriate key performance indicators. I think that a lot of people have quite distant observation dates for those performance indicators, and I think investors would like to see a medium-term transition pathway on the way to, what are the milestones on the way to 2030 that you aim to achieve. I think a lot of companies, as they set out the net zero targets for 2050, are anticipating technological innovation that we haven't yet seen in the market. And I think, that's something that will require government support and policy support to encourage these kind of developments. But no, I think from our side, we see sustainability-linked bonds and key performance indicators as a very interesting way to bring companies in the hard-to-abate sectors who don't have the obvious use of proceeds that you can label today as being green. I think we see it as a very useful instrument.
Thank you for that. Yes, indeed. We're seeing a lot of the examples from the hard and expensive to abate industries. Julie, what do you make of SLBs?
Well, I completely agree with what Philip and other speakers explained about SLBs. These are really innovative, but also inclusive sustainable financing instruments in the sense that indeed they allow any company in all industries to transition, even if they are unable for different reasons to finance a specific green or social project. And this is absolutely important to encourage all the industries to transition. What is so interesting to underline is that it also helps broaden the scope of sustainable finance investment opportunities for investors. As we all know, labeled products, unfortunately, are not enough. We lack supply of that kind of labeled investment opportunities, and so broadening the scope to sustainability-linked bonds or even bonds issued by climate-aligned issuers, as you are working on since years already, are very important elements to help investors to meet their ESG mandate and to be able to report on SFDR and other regulations they have by which they have to demonstrate how they incorporate ESG into consideration in their investment policy, in their risk strategy, another element I'd like to mention about SLBs is also that, as Elvira mentioned earlier on, we haven't seen yet any sovereign or municipalities issue that kind of product so far. Maybe it's difficult indeed to imagine what kind of KPI they produce, but at the same time, because we are approaching COP26, we can also think about what all 196 signatories of the Paris Climate Agreement did in 2015 at the occasion of COP21. They all adopted the Paris Agreement by defining nationally determined contribution that could be used as a KPI as well. So just an idea, but this is something which might help sovereigns to issue more sustainability-linked bonds. And another element, because we extended our platform on that kind of products last year, and we indeed, as Philip mentioned, see a huge growth in the issuance of that kind of products. And an interesting case study is, for instance, Verbund, because now we talked earlier on about the taxonomy and alignment with the taxonomy and now with SLBs, but we saw recently a combination of the both. So Verbund, in particular, issued a very innovative bond in the sustainable finance market with the first EU taxonomy aligned innovative green bond and SLB. So mixing and combining the two objectives, clearly defining environmentally sustainable, so green use of proceeds with a coupon step up, which is linked to the company-wide sustainability targets. So the proceeds of the bond will be used to finance both the renewal and the expansion of an existing hydropower plant and the expansion of Verbund's power grid in Austria. And I think that's interesting also to mention that some issuers, even if they are quite rare for the moment, but manage also to combine both. And at the same time, also meeting investors' requirements, because more and more investors, indeed, as it was already mentioned, want to understand, don't want to invest only in a green side project, but really want to understand what is the overall sustainability strategy of the issuer. And more and more investors, indeed, are also really including climate risks and opportunities within their analysis and decision-making process. So that's where we also see that climate-related information is becoming, at the end, a new set of financial information for investors.
Absolutely. These are all material impacts. Thank you, Julie. And I'd like to congratulate the panel on giving such a lovely overview and whetting our audience's appetite for the rest of the agenda for the week. We do have a dedicated Transitions Day on Friday, where we will also be publishing further guidance and sort of CBI thinking, obviously drawing heavily on our stakeholder bases on assessing entity-level transition strategies. So stay tuned for that. I wanted to turn to Elvira. You were smiling at the suggestion of the sustainability-linked sovereign bond. We've heard whispers from Brazil that might be something that they're looking at as an option. Does that resonate with you? Mixing and matching the so-called ice cream flavors, as Sean Kidney would call them.
I'm also always attracted by coming up with new ideas and pioneering where it's helpful. And of course, we've been following the SLB debate closely. I think we're still struggling a bit how it would work for sovereigns. And I agree with Julie that we have these NCD targets that you could apply. At the same time, they're very high level. So you may wonder how useful they are as KPIs. I think also on a government level, you have an extremely high degree of uncertainty and external effects that could impact these KPIs to be reached. I think it's something seriously to study further. I do think that there's a higher level of complexity from a government point of view to have ambitious though realistic targets to be set, that you have really a confident idea on reaching them. Also having a coupon step up being introduced in a government cycle of interest payments. So introducing a higher level of uncertainty. So if the interest payments go up somewhere else within the government budget, things will need to go down and to be cut. I think these are difficult points to tackle. Not to say that we wipe it out completely, but I do think it's more complex. But I take the encouragement to keep on studying this, to what extent it's applicable to governments.
Excellent. Stephen, would you invest in this kind of instrument if you saw a sovereign SLB? Is this a mechanism to get it to go a bit more mainstream? I know we've talked about the sovereign transition assessment and identifying opportunities there a lot. I'd love to hear from you.
Yeah, I think at one level, I think it adds complexity to the market. I mean, in the sense that, if you look at the investors' side, having a kind of step up coupon or step down coupon is something that, I guess, for pure fixed income investors is something that would add complexity. But having said that, these are not, the notion of changing coupons dependent on metrics exists already in subordinated financial instruments, for example. So it's not a new concept. It's never been. I wouldn't suspect that it would become the kind of mainstream. I think it would be an area which could serve a purpose, and I don't think complexity, for the sake of complexity, is a good thing. But to the extent that it helps issuers access the market and do so in a way that that brings issuers to genuinely do more on this subject than they would have done without, I think it's to be welcome. But I do, I do think that there are other structures already out there that meet the needs of investors who want to invest in sustainable bonds. So I wouldn't expect it to become the dominant the dominant structure out there. So I think that I'd reflect on it that way. I mean, it's not, again, I'd say it's an area definitely to watch, but I think kind of the more mainstream parts of the sustainable market at the moment are going to kind of do the bulk of the lifting, I guess, in the short term at least.
And that's obviously backed up by the current market composition. So it's absolutely fair enough to say that. Keeping with the sort of government theme a little bit, but shifting gears slightly to Sean, there's an audience question on the Chinese sustainable bond market. Specifically, how much influence do you think government policy in terms of recent moves towards improving education, investing in real estate, technology, etc., have on issuers' access to capital? And how they improve ESG standards and impact and even yields. So this is a multi-pronged question, but any reflections?
Right. I do believe that investors have one of their primary concern is how much return that they can get from these green or ESG or sustainable link related instruments, as referring to those conventional instruments. As one of their analysis. But from our perspective, I think Philip earlier also mentioning that one of the primary objectives is to how to set these alpha and KPI linked to, for example, carbon reductions, environmental protections, et cetera, et cetera. So to begin with, we do believe that the government initiatives and policies do have motivations and drivers behind all these, and law and regulations. Secondly, would fill in those gaps. How the dynamic of participants and the issuers will mixed up together, and to solve some of the issues that Stephen have mentioned about the diversity, about the liquidity of the system. So all these add up would comes to the investor's standpoint, whether this particular market, they are sustainable enough or feasible to invest into. But like we said earlier, China becoming a big contributors to sustainable green market, and without investing into this part of the region, we do believe that it limits the scope of diversification, and most important of all, that will reduce the chances of balancing those carbon reductions opportunity, which one might find lots of these interesting ideas here in China and Asia. Thank you.
Thank you very much. That environmental benefit angle brings me to something that we haven't touched on yet, which is valuing nature and investing into nature. You probably have heard that there's now a task force for nature-related financial disclosures, building on the TCFD, which is looking at mitigating and adapting to climate change. Philip, maybe I can start with you. Have you seen any interest in or sort of been involved in conversations with market participants on attempting to include direct impacts or improvement of nature-related and nature-based outcomes in these instruments?
Yeah, I think biodiversity is something that is very interesting to many investors, particularly with regard to emerging market. And we have a number of discussions ongoing with African sovereign issuers with regard to biodiversity and avoiding deforestation, for example, these kinds of issues. We also have recently executed Blue Bond for one of the world's supranationals, which is for a project to remove plastics. One of the financing projects on the use of proceeds for this Blue Bond is with regard to reduction of plastics in oceans and so on. So I think these initiatives, which again are coming from the European Union, are very helpful in terms of putting definition again on a taxonomy for nature. But yeah, I think the preservation of natural capital is going to be a very important component of achieving a 1.5 degree target. So I think these are very important and significant issues, and we're going to see rather more of this issuance in the months to come. We are working on a number of projects in that regard.
It's great and very encouraging to hear. Elvira, has this been something of a feature in your conversations about future funding strategies? I know there was a small component of this in your original framework already. Is it a difficult topic to sort of wrap your head around?
When we designed our green bond framework, we also tried to be a bit selective in what kinds of expenditures we included in the framework. So we included renewable energy, energy efficiency, transportation, and adaptation. So 4 categories. And I think you also have to be mindful as an issuer that you need to report on all these categories for quite some years to come. So I would also advise future governments to keep your green bond framework simple, because you need to report on it and have some credible indicators on biodiversity. I know it's important to the investors. We've seen recent surveys also in the investor community, and their feedback is clear that they value investments being done in terms of nature conservation. From a government point of view, we need then solid plans to back our bonds. And to have the green bond proceeds be included in a framework. So we need the government to make up these plans. I know that there are quite some intense debates within our country on the careful balance to be made here. Farming, having pieces of land being protected and have it as a conservative area. So we need to await these plans from government, but we know that the investors value the part of biodiversity greatly. We have not included in our current framework, but this may be included in our future ones.
We hope to see more of that. And what I'm hearing from the both of you is essentially the definitions that will come out of TNFD and other initiatives will be quite instrumental in guiding the development of this market. Philip, final remarks on this, and then we'll do a wrap up. We're nearing time. Thank you.
Yeah, I mean, we just recently published a very interesting report on, everybody can Google it, on City GPS, which is biodiversity, which is the title of the report is Biodiversity, the Ecosystem at the Heart of Business. And there are just some remarkable statistics that, every 6 seconds, forest the size of a football pitch is being cut down. And if we were to look at tropical deforestation, it would rank 3rd in CO2 equivalent emissions if it were a sovereign in itself. 75% of tropical deforestation is driven by 4 commodities: cattle products, soybean, palm oil, and other forestry products. So I think this is fundamentally linked to climate change, and as is social issues are also becoming inextricably linked to climate change. So everything is coming back to the overwhelming issue of climate change.
Absolutely, and there is overwhelming evidence to suggest that these are also all interlinked with the pandemic within which we find ourselves. So going back to Sean's point as well, these vast landmass countries such as China would do absolutely splendidly to include these things going forward. I am very pleased for your participation and so grateful to have had you on this panel today. We've got a few more minutes to before we get cut off. So a sort of 10 to 15 second last thought to take away from this panel, if you will. I will start with Julie, please.
Maybe just to add on what Philippe just mentioned about deforestation and biodiversity, and to link this with sustainability linked bond we were debating before. There's also an interesting report which encourage more sovereign or municipality to issue SLBs, but that are especially because they could be linked, for instance, in Brazil to deforestation linked sovereign green bond that we might see also in the future. So everything is strongly linked, and especially because SLBs also allow to maintain the integrity of the market and avoid or prevent greenwashing, in a sense that issuers are really accountable for what they are doing. They need to embed all the bond characteristics in the legal documentation, which brings also a lot to investors.
Thank you, Julie. I'm going to ask the rest of you to give one-liners because we are going to get caught in the middle. Lisa, please.
Sure. So I would say there's great opportunity in the market with the GSS market making up less than 1% of total U.S. bond issuance. So I think that we're looking for innovation and standardization in the future.
Beautiful. Thank you. Elvira, please.
Very short, as I said, governments are catalysts to the green bond market. It's not only a nice to have, it's a must have. It will increase cost of funding on government level if climate issues are not being tackled. So it's a must have, it's here to stay. It's a license to operate for governments. So we really hope to see more governments going green.
Absolutely right. Thank you. Sean, please.
And thank you. As we notice, China bonds has been added to those major indices around the globe, and definitely it would be more interesting to see China climate initiatives bonds or green bonds or sustainable bonds to be included in other major green indices in the future. That will make the global market more exciting. Thank you.
Thank you so much. Philip and Stephen, please.
So I think we're not very far away now from every capital market instrument being looked at through an ESG lens. And, I think we're only 1 or 2 years away from investors looking at every bond issuance out there and considering whether it is green or sustainable. And if it's not one of those two things, then perhaps it is something which is by definition unsustainable. And therefore, this is critical to the future of capital markets. It's with us today.
Thank you. And very quickly, Stephen, thank you.
I think the panel kind of encapsulates what we need to do more of, which is have broad geographies, broad market participants really genuinely interested in helping be part of the solution for this. And so I am optimistic, more optimistic after this panel than when I came into it. But there is a lot of work to do. And I think it's important for us to not forget that I don't think it's yet mainstream, and I think we've got momentum. And if we continue to do what we're doing and accelerate what we're doing, then we can make it mainstream.
Thank you. Thank you for the optimism. Thank you to our stellar panel, our audience, our sponsors for your participation. And I wish you all a fantastic rest of the conference week and a lovely rest of your day. Take care.